Markets resumed their march lower last week as investors have found no place to hide amidst rising risks stemming from the conflict in Iran. As of the close on Friday, the S&P 500 was down 7% year to date, with oil up 85% and the US 10-year Treasury yield rising to 4.43%. This morning, President Trump is trying to downplay risks of a prolonged conflict, in part to satiate markets. That may help with a short-term bounce, but we think that at this point, investors need to see an actual resolution or a realistic pathway to one in order to gain durable confidence. As fundamental investors, we much prefer focusing on company and economic developments as compared to geopolitics. But the truth is that the only issue that matters right now for financial markets and the global economy is the US conflict with Iran. And the only question that matters is whether spring of 2026 is more akin to spring of 2025 or spring 2020. Is this a replay of the tariff tantrum, a policy-induced shock to the system that can be walked back? Or is this a replay of something closer to the breakout of COVID, where the market isn't simply mispricing risk, it's becoming incapable of pricing it at all because the risks have moved beyond easily quantifiable damage to the global economy grinding to a halt? Given that potential outcome, diversification across asset classes is perhaps unsurprisingly failing to provide much protection in this environment. To be clear, we're not trying to catastrophize the current situation and note that in each case, tariffs and COVID, markets sharply rebounded at signs of a resolution and curtailment of risks. However, there is a real and growing threat that a month of the largest energy supply disruption in modern history has set in motion consequences that may outlast the conflict itself. The Strait of Hormuz is effectively closed, Gulf energy infrastructure is degraded. Aside from energy, supply chains ranging from petrochemicals to fertilizers to industrial gases and even semiconductors are under stress. And Iran's strategic incentive may be to extend this conflict as asymmetric escalation is the one area where they hold leverage. Every week this continues, the disruption deepens, not linearly, but in a manner that compounds. We think the administration must realize this and that hopefully it informs their operational calculus. It's important to note that the US is relatively better positioned for this conflict than most other countries. Domestic energy production has fundamentally changed our vulnerability to Middle East supply shocks, but energy independence does not insulate us from the global supply chain effects that are already building. This cannot and will not go on forever. The economic costs to all parties, including Iran, are too severe. But it is disruptive now, and we think investors need to be clear-eyed about what that could mean for their portfolios in the near term. Aside from positions in energy, defense, and perhaps healthcare, it's difficult to avoid the impacts of this conflict with Iran. That said, data from Goldman Sachs shows that we are seeing some of the most aggressive selling since COVID, the kind of indiscriminate de-risking that tends to create dislocations in longer-term opportunities. The most important thing investors can do right now is honestly assess their risk tolerance and time horizons. For those with longer time horizons beyond the next few months, the structural drivers that were in place before this conflict remain. Ultimately, we do remain constructive on markets because the pace of innovation in the economy, which was accelerating, will survive what we think will prove to be a short-lived, but albeit potentially sharp downturn. As prices fall, we're carefully evaluating opportunities to establish long-term positions in companies with proven business models and compelling valuations, as well as in firms positioned to capitalize on AI-enabled possibilities. If you have any questions or concerns, please feel free to reach out to us. Thank you and have a great week.